Joining us now is Max Wasserman. He is Senior Fund Manager at Miramar Capital. Max, good to have you on. What does de-risk a portfolio mean to you?
Well, thank you for having me on. What we look at de-risking is take some money and take the profits, if you will, in some of these large cap Magnificent Seven. We're not saying get out of them, but we're saying they have run up so much over the past 2 years, and the valuations are so high. Don't expect that rate to continue. And for people owning these stocks that have gone very high in their portfolios, de-risking means bring it down. So, we have investments in some of these Magnificent Sevens, and they've grown 6-7% in our portfolio. But we are trimming these positions because at these valuations, we think it's asymmetrical risk reward. So when we say de-risk, we mean lower our exposure to some of these high beta stocks because they've been running at such a level. And in the bond market, we think stay short term, because we could see people surprised and see a 10-year floating at about 5% or higher next year. If
we're selling some like the NVIDIAs of the world, and they've made just bags of money. I mean, they've done fantastically well. I get your point. What are we using the proceeds for? Are we putting it under the mattress, Max, or are we going to reinvest some of that hard-earned and well-made capital into something else? And if so, what else?
Sure. I mean, there's other parts of the market that are trading at more reasonable valuations. And we think the equal-weighted part of the market looks more valuable and better returns on you. So if you look at healthcare companies, we like them. We like the Mercks. We like the Bristol Myers. We like the AbbVie. When we're dividend growth investors, so we're being paid to wait. So we like getting 3-4%. We also like some of the defense stocks that have pulled back here, the Lockheed Martins and the General Dynamics. What we're saying is you've made so much money for the past 2 years, and everybody's anticipating that the Fed put is there. But keep in mind, the Fed has already told you they're backing down the number of cuts. So imagine if you get a higher interest rate, these could really kill the growth stocks. So we're not getting out of them. We still like it. We like a Microsoft at this pullback. We like a Qualcomm. So we like companies, but we're saying the Magnificent Seven has been priced to perfection. And as you know, everybody's pricing these things like you're going to grow at 20-30% a year for the next 3 to 5 years. And historically, that doesn't happen.
Because I'll be in the city lately and I'll be in a taxi cab, Max, and I'm just telling you, there's a good chance the taxi cab guy is going to recognize, because they have CNBC on, in the taxi cab, he's going to ask about NVIDIA. Because I hate to be like a broken record, but it does remind me of 2000 when people were saying, well, I'm just in it for the 20%, like it was a guaranteed thing. Nothing in the stock market is or should be guaranteed, correct?
Well, I agree with you, and it does take me back because I remember being in the cabs in New York City and in Chicago where I'm at, and the taxi driver telling us to buy internet stocks because they were the church of what's working now.
He's telling you
everything.
What
They're
to buy.
telling me. And we're cautious. I mean, again, you've made money. We're not saying get out of them. We're saying lower your exposure to some of it. I think you're going to get a pullback in this market because it's priced for perfection. We've all seen it. You saw just what happened when the Fed changed their mind a little bit. You saw a 3.2% pullback in the NASDAQ in just one day. We don't see what you're seeing right now as a major pullback. We're talking about a 10% pullback. Should be coming. When, I can't tell you. But if you get a 10% in the general market, that means those Magnificent Seven could pull back even more. And so all we're saying is redeploy some of your capital to safer, I say, lower valuation, dividend growing stocks, and we think you'll be rewarded.